Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video, we're going to be talking about 8 high quality dividend stocks that are considered to be undervalued or reasonably valued at this time. And all of them do pay a dividend yielding more than 5% at this time. Without any further ado, let's get into it. All right, our very first pick is Magellan Midstream Partners with ticker symbol MMP. This energy sector company has a market capitalization of $10.5 billion, and it has a beta score of 0.53, which is considered to be low, suggesting that this stock is low in volatility. Beta is a measure of volatility, and a beta of under 1 suggests that the stock is less volatile than the overall stock market. The stock, as we indicated here, is considered to be appearing to be undervalued and has a dividend yield of 8.35%, which is quite remarkable to see. Their price to earnings ratio for Magellan Midstream Partners is only at 9.5, which is considered below 5-year average, and it's a nice number in that sense to see. The lower usually the price to earning ratio, it does suggest that the stock is being traded at a kind of a smaller premium, and it's priced better from that sense. The dividend safety score for Magellan Midstream Partners is currently at 61, and the company has been paying its dividend uninterrupted for the past 20 years, and in all of those 20 years, they have increased their dividends. Looking at the payment schedule for Magellan Midstream Partners, you're looking at the dividends being paid on the month of February, May, August, and November. The payout ratio for Magellan Midstream Partners currently is at 81%, which is edging high for MLPs. But all in all, it's not the biggest red flag, and overall, it's considered to be a safe dividend payer, as you notice, with its score of 61. Magellan Midstream Partners has been showing positive free cash flow in all of the last 10 years, supporting its ability to pay for dividends. And even during the recession years of 2007, 2009, they continue to increase their dividend during that time frame, which is a positive sign for us to see. Looking at the past 1-year return for Magellan Midstream Partners, the 1-year return is showing to be positive 16.82%, and the past 5-year return is down by 34.96%. However, if you look at the 10-year return, it's showing to be positive 37.60% from a stock price perspective. Our second pick is another energy sector company, Enterprise Products Partners, with a market cap of $54.4 billion, making it a large cap size company. The beta is only at 0.38, making it a very low volatility stock, which is appearing to be undervalued at this time. Enterprise Products Partners with ticker symbol EPD has a dividend yield of 7.37%, and it has a price to earnings ratio of 8.2, which is below its own 5-year average. It's a positive sign to see. The dividend safety is at 65, making it a safe dividend payer. And Enterprise Products Partners has been paying its dividend uninterrupted for the past 23 years, and in all of those years, they have increased it year after year, with their quarterly dividend payments paid on the months of February, May, August, and November, similar to that of Magellan Midstream Partners. The Enterprise Products Partners has been showing a payout ratio of 61%, lower than that of MMP, and it's still also considered to be low for MLPs. In terms of the free cash flow, Enterprise Product Partners has been showing positive free cash flow in 9 out of the last 10 years. And during the recession of 2007, 2009, they managed to continue to increase their dividend payments. As for the return for the stock, the 1-year return is at 12.78%, and the 5-year return is at negative 6.8%. Our third pick is a company called Main Street Capital, ticker symbol MAIN. It's a financial sector company with $2.99 billion, making it a mid-cap size company. The stock has a beta score of 0.80, considered to be low volatility, and does appear to be reasonably valued at this time. With a dividend yield of 6.15%, it has a price to earnings ratio of 14.7, which is below its own 5-year average. It's worthwhile mentioning that Main Street Capital has a dividend safety score of 62, making it a safe dividend payer. It has been paying its dividend in the past 14 years uninterrupted, but in 11 of those years, in the past 11 years, they've increased their dividend year after year. They do pay their dividend on a monthly basis, and they're currently having a payout ratio of 94%. Although it may appear high, but it's overall considered to be low for business development companies. They have shown a positive 1 year free cash flow in the past 10 years. During the recession of 2007-2009, they managed to maintain their dividend. They did not increase it, and nor did they cut it. Looking at the stock return in the past 1 year, the stock was up by 9.8%, and in the past 5 years, it was up by close to 13%. Next on our list, we have Medical Properties Trust, with ticker symbol MPW. It's another real estate company with a market cap of $12.1 billion, making it a large cap size business. With the stock having a volatility score of 0.72 for its beta, suggesting low volatility and appearing to be reasonably valued at this time. The dividend yield for Medical Properties Trust is at 5.69%, and this dividend is paid on a quarterly basis in the months of January, April, July, and October. Medical Properties Trust has been paying its dividend uninterrupted for the past 12 years, and in the last 9 years of that, they have increased their dividend year after year. With a price to earnings ratio of 14, which is in line with their 5-year average, Medical Properties Trust is showing a dividend safety score of 70. Their payout ratio is at 81%, which is low for medical building real estate investment trust, and the free cash flow in the past 10 years has been the case in all of those 10 years. During the recession years of 2007 to 2009, they cut their dividend. And that's worthwhile paying attention and being mindful about. Looking at the stock price return for Medical Properties Trust, the past 1 year, the stock is down by about 4%. However, in the past 5 years, the stock is showing to be up by 60%. Next on our list, we have Philip Morris International, ticker symbol PM. It's a consumer staples business with $141 billion in mega cap. It has a beta score of 0.36, which is a very low beta, suggesting very low volatility for Philip Morris International stock. It does appear to be reasonably valued at this time with a dividend yield of 5.4%. As for the price to earnings ratio for Philip Morris International, it is at 14.8, which is in line with their own 5-year average. The dividend safety score is at 64, making it a safe dividend payer. The company has been paying its dividend and increasing it over the past 13 years, year after year. In terms of payment frequency for its dividend, Philip Morris International pays its dividend quarterly in the months of January, April, July, and October, and has a payout ratio of 81%, which is edging higher for tobacco companies. In terms of cash flow, they are showing positive free cash flow in each of the last 10 years, and during the recession years of 2007 to 2009, they managed to increase their dividend. As for the stock price return, looking at Philip Morris International stock charts, the past 1 year, the stock was up by about 4.6%, and in the past 5 years, though, it was showing to be down by 17%. Moving on and looking at our next pick, we are looking at Store Capital, another real estate business with ticker symbol STOR, with a market cap of $7.98 billion and a beta of 0.99. Store Capital has a dividend yield of 5.28%. It is appearing to be undervalued at this time, and with a price to earnings ratio of 13.2, which is below 5-year average for Store Capital. The dividend safety score for Store Capital is at 70, making the safe dividend payer, and they have been managing to pay their dividend and increasing it year after year for the past 7 years. Store Capital does pay its dividend quarterly in the months of January, April, July, and October, and their payout ratio is at 73%, which is low for real estate investment trusts, giving them a ton of room for increasing their dividend amounts. They are showing positive free cash flow in all of the past 10 years, but during the recession years, they were not paying dividend, given their history of dividend payment uninterrupted for the past 7 years. As for the stock return for Store Capital, the 1-year return is down by about 11.5%. However, the 5-year return is showing to be up by close to 23%. Moving on and looking at our 7th pick, we're looking at international business machine, IBM, with market cap of $115 billion, making it a mega cap sized business. The beta score for IBM stock is only at 0.45, which is very low, suggesting low volatility for IBM. It appears to be reasonably valued at this time and has a market dividend yield of 5.08%. The price to earnings ratio for IBM is at 12.9, which is above 5-year average for its own stock. As for dividend safety, we are looking at 65 score, and that suggests a safe dividend. IBM has paid its dividend uninterrupted in the past 27 years, and in the 26 last years, they have increased it year after year. They do pay their dividend quarterly in the months of March, June, September, and December, and have a payout ratio of 66%, which is edging higher for most companies. Although it can be a little bit of red flag, it's worthwhile mentioning that they are showing positive free cash flow in the last 10 years. And during the recession years of 2007 to 2009, they managed to increase their dividend payments. On top of that, if you look at their past stock return, the 1 year is only down by about 1%. But however, in the past 5 years, the stock is down by close to 26%. Lastly, our eighth and final pick for high quality, reasonably valued or undervalued dividend stocks with a dividend yield of more than 5%. You're looking at Verizon, a communications sector business with $214 billion in the market cap, making it a mega cap sized business. With a beta of 0.37, Verizon stock is very low volatile. It appears to be undervalued and has a dividend yield of 5.02%, with the price to earnings ratio of only at 9.3, which is below its own 5-year average, and a dividend safety score of 87. Verizon appears to be a very safe dividend payer. They have been, in fact, paying their dividend uninterrupted for the past 31 years, and in the last 15 years, they managed to increase their dividend year after year. Verizon does pay its dividend quarterly in the months of February, May, August, and November. Their payout ratio is only at 47%, which is very low for telecoms businesses and giving them a ton of time and room for increasing their dividend amounts. They are showing positive free cash flow in 9 out of the last 10 years, and during the recession years of 2007 to 2009, they managed to increase their dividend amounts. As for the stock return, the 1-year return is down by about 10.5%. However, the past 5 years, the stock is up by close to 2.7%. Well, there you have it, folks. A quick look into 8 high-quality businesses that appear to be undervalued or reasonably valued at this time, and they all have a dividend yield of more than 5%. Hope you found this video beneficial and gained something of value from it. If you did, please give this video a thumbs up and share it with someone else who might benefit from the video. And of course, subscribe to our channel. Here on Moementum Finance, we post every week several videos about investing, whether it's investing in dividend stocks, growth stocks, cryptocurrency, real estate, as well as discussing ways to reach financial freedom. Thank you, and I hope to see you next time.